Moving on, NIIT Learning Solutions is the company in focus. The company just reported its Q2 earnings. The net profit came in 21% higher, but its margins have contracted. To discuss this and more, we have joined by Vijay Thadani, the co-founder of NIIT and the vice chairman and managing director at NIIT Learning Solutions. Good afternoon, Mr. Thadani. Thank you so much for joining us. We just had a look at the investor presentation that you've just uploaded onto the BSE website. It appears as though BFSI this time around has kicked in, but sequentially some softness is seen. Take us through the highlights of Q2.
Yeah, okay. So I think Q2 is for historical reasons, is a slightly softer quarter, if you see every year. But this year, in addition to being that, and that, by the way, happens because of holidays in Europe and stuff like that, also because of how professional services and consulting firms, for them, the previous quarter has been their highest. So they start their first quarter, most of them have this as their first quarter, they start on a lower note. But in this case, we also had the impact of the North America real estate contract that we have in North America for training realtors. That took a dip, a fairly strong dip because of the interest rates as well as what else is happening in that part of the world. So I think those are some of the contributors. And of course, the professional services and consulting have also been lower, even though they are historically lower, but they've been a little lower than what they should have been.
So, Mr. Thadani, what is the outlook for the second half? Will you be able to do the revenue growth guidance that you had given of 12 to 14%, EBITDA margins of 20 to 24%? Asking because EBITDA margins have fallen on a YOY basis. Is this because of the same reason that you just mentioned?
No. EBITDA margins that we have seen are because of the product mix. In fact, they are fairly robust. The EBITDA margin at 24% is actually a little beyond what we were expecting. And I think we will continue to see that 22 to 24% margin for the rest of the year, with the margin being on the higher side of the 22-24 range. So we are very well placed as far as the margin is concerned. On the growth, given the multiple environmental conditions which are happening, where economic indicators are very strong, but the sentiment is weak, and I think cost cutting is the real issue. I think in medium term, it offers a great opportunity for us because whenever cost cutting becomes the driver, outsourcing increases, and that's our main business. And I think we are very well positioned to recover from this in medium term. But for the year, our guidance now will be 7% plus.
Okay, so you are saying guidance will be 7% plus versus 12 to 14% earlier.
That's right.
So the reason for this...
Sorry?
Yes, please go ahead. You were saying that is because of?
The weakness in the environment. As I said, the economic indicators are good, but the sentiment is weak. And therefore, while we have a very good contract base, we have very good wins this quarter also. We got 2 new MTS contracts. I think in the short term, while we recover from these, and as you know, there are multiple macroeconomic indicators at work. So I think while we will recover in the second half, our second half will do much better than the first half. But I think we are running about a quarter behind in order for us to meet the projections that we had talked about.
Got that, Mr. Thadani. You've also mentioned that you have a 100% retention rate in terms of actually going ahead and renewals. Now, give us a sense of these renewals. Are they happening at the same levels, or are you seeing some cost cutting? Are they happening at slightly lower levels compared to what it was last year?
No, in fact, the renewals are actually pretty good, and renewals start with an expansion as well because they are happy with us and they increase the level of work. What happens is what was traditional consumption, people have been cautious in consuming the same amount of learning given this uncertainties in the environment. But I think all these are very short-term issues. We are very well positioned in our overall guidance over the years.
Exactly. That's what I was going to ask you, because you do have a long-term guidance, Mr. Thadani. You're targeting $400 to $500 million of revenues by FY27, which could mean a CAGR of 30%. That's on track, right?
Yes. That, of course, also includes inorganic. And,
yes.
And definitely we have opportunities there also.
So any inorganic opportunities that we can look forward to this year itself, anything that's in the pipeline and the street can hear from you?
Many in the pipeline, and you will hear them as soon as they are finalized.
So is there a kitty for acquisitions that you've kept aside?
Yes. We have more than 700 crores cash sitting in the bank. In fact, we are adding cash in that bank, in that account as we go along. And I think we are building up the kitty. We did one acquisition, as you know, St. Charles Consulting. And that acquisition has played out well, and I'm sure it will play out well in the future as well. But overall, I think there is opportunity, given the way our business is structured and given the way the opportunities are coming up. I think our generative AI practice has really taken a pole position, and I think that will be a very big contributor to our growth as we go forward. Because more and more clients and the learning is benefiting a lot from AI.
Mr. Thadani, on a year-on-year basis, last year around BFSI contributed close to 8% of your total revenues. This time around it's close to 14%. So going forward, how do you see the revenue mix? And you've also given some positive commentary as far as BFSI is concerned. So do you see that mix trending higher?
Yeah, see, at this point of time, BFSI is sitting on a lot of money with high interest rates, right? And also BFSI is going through a major transformation, the digital transformation, which is happening in the world. And with the purse strings loosened, I think they are in a hurry to be on top of the technology curve. And I think to that extent, it presents a great opportunity. So I would say BFSI and pharma, life sciences, they are two sectors which are doing very well. Technology is a sector which is beginning to recover now. And I think we will see that contributor. These are three out of the big four sectors that we have always been very, very positive about. So 3 out of 4 are actually at this point of time doing well. We do believe professional services and consulting, which is right now taken a small dip, but I think they will recover over a period of time as things stabilize and as the sentiment starts improving with the interest rates coming down and with the buoyancy in the environment and more clarity. I think uncertainty is the single largest contributor for holding people spending on learning and development.
Totally makes sense, Mr. Thadani. Thank you so much for joining in today and giving us a sense of what's happening on ground, right? And that gives more perspective of what the ground reality is like. Thank you so much for joining in today and giving us all those insights. So that's the word coming in from NIIT Learning, talking about some pressures on ground, some of the segments doing well, technology is coming back, but still they have cut their growth guidance to 7% versus 12 to 13% earlier. We'll slip into a short break. When we come back, we'll talk more about markets and a lot of stock-specific action. Stay tuned for that.